Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly newsletter. Today's date is the 17th of March. Let's dive into the week's stock market news. European markets slide on tariff and rate hike uncertainty. Policymakers divided on further ECB cuts. European stocks closed mostly lower, with the Pan-European Stocks Europe 600 index declining by 1.23% in local currency terms. The drop was fueled by concerns about the potential impact of U.S. trade tariffs on global economic growth, coupled with uncertainty surrounding future monetary policy decisions. Losses were partially offset by optimism regarding potential ceasefire talks between Ukraine and Russia, and news that Germany's incoming chancellor had garnered parliamentary support for a significant increase in state borrowing. Performance across major European stock indexes was mixed. France's CAC 40 index saw a notable decrease of 1.14%. Germany's DAX and Italy's FTSE MIB managed to secure slight gains. The UK's FTSE 100 index experienced a 0.55% decline, a few days following the European Central Bank's (ECB) decision to reduce interest rates, the sixth such cut since June. A series of comments from policymakers raised questions about the likelihood of another rate cut in April. ECB President Christine Lagarde, speaking in Frankfurt, indicated that exceptionally high uncertainty could hinder the ECB's ability to achieve its 2% inflation target in the near term. Isabel Schnabel, a member of the executive board, expressed concerns to the Handelsblatt newspaper that inflation was more prone to remain above the target than fall below it, signaling her hesitancy to support further easing. Governing Council member Martins Karzaks, speaking at a conference in Lisbon, as reported by Bloomberg, emphasized the need for policymakers to maintain an open mind regarding the April decision, citing uncertainty stemming from geopolitical events and a possible substantial rise in defense spending. Conversely, Bank of Portugal Governor Mario Centeno, in an interview with the Wall Street Journal, maintained his stance that lower borrowing costs were necessary to bolster the weak economy and prevent inflation from settling below the target, stating his preference for earlier rather than later action. The UK economy faced challenges in boosting growth, with an unexpected 0.1% contraction in January, primarily due to a decline in production. This followed a 0.4% sequential expansion in the previous month. Despite the monthly decline, the rolling quarterly growth rate improved slightly, reaching 0.2% compared to 0.1% in December. In Germany, Reuters reported, citing two sources familiar with the negotiations, that the incoming coalition government and the Greens have reached an agreement to significantly increase state borrowing. Incoming Chancellor Friedrich Merz is seeking approval from the outgoing parliament for a €500 billion infrastructure fund and a relaxation of the debt brake to facilitate increased defense spending. Now our insight into alternative markets, navigating the trade storm. How private equity adapts to Trump's tariffs in the ever-evolving world of global trade. Private equity, PE, firms find themselves once again steering through turbulent waters. President Donald Trump's recent tariff proposals have injected a fresh dose of complexity into the investment landscape, pushing the industry to respond with agility to an unpredictable economic climate. While these tariffs pose significant challenges, they also offer a unique stage for PE firms to display their resilience and resourcefulness. The effects of Trump's tariffs ripple far beyond their initial intent. Originally aimed at correcting perceived trade imbalances by targeting goods, These measures now loom with the potential to expand into services, casting a cloud of uncertainty over multiple sectors. Industries tied to international trade feel the strain most acutely, as the prospect of broader tariffs threatens to disrupt long-standing business models. This upheaval is prompting pay firms to reassess their approaches in three pivotal areas: mergers and acquisitions, M&A, activity, supply chain management, and overall investment strategies. In the realm of M&A, caution has become the watchword. Where deals once closed with speed, tariff-related uncertainty now slows the process. Firms are extending due diligence periods, poring over data to understand how tariffs might chip away at a target's bottom line. Stricter terms, such as earnouts and contingent payments, are increasingly common, providing a buffer against the volatile trade environment. This shift reflects a broader trend toward risk aversion as pay players fine-tune their deal-making playbook. Valuations, too, are feeling the tariff squeeze. Companies reliant on cross-border trade, imagine manufacturers with vast import/export networks, are watching their valuations shrink as rising costs erode their edge. Meanwhile, businesses less exposed to trade disruptions, particularly those with a domestic focus, are capitalizing on the moment, fetching premium prices. This divergence is redrawing the investment map, compelling pay firms to reconsider where true value lies in a fractured market. To protect their portfolio companies from tariff fallout, pay firms are driving a wave of supply chain reinvention. They're urging a reevaluation of supplier locations and production sites, seeking out jurisdictions with more favorable trade conditions. For some multinationals, the effort goes deeper, with meticulous documentation of pricing adjustments to head off potential scrutiny from tax authorities. It's a strategic game of high stakes, with every decision aimed at sidestepping tariff-driven costs. Far from merely reacting, pay firms are reimagining their strategies to weather these turbulent times. Due diligence has evolved from a quick glance to an exhaustive dive, with firms analyzing tariff scenarios to forecast long-term impacts on revenue and operations. Deal structures are getting a creative overhaul, incorporating earnouts tied to post-tariff performance and contingent payments that align buyer and seller interests, while softening trade-related shocks. Staying proactive is critical, and firms are keeping a close eye on policy developments, tapping trade experts and legal advisors to adjust their plans as the tariff landscape shifts. Trump's tariffs may put private equity to the test, but they also ignite opportunity. By sharpening due diligence, embracing flexible deal-making, and leaning into forward-thinking risk management, pay firms can do more than just endure, they can excel. This period of uncertainty doubles as a catalyst for innovation, a chance to unearth hidden value, and a testament to the industry's enduring strength in the face of adversity.
Thank you for listening to this episode of Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode, and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, hubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.